wind up having a profit. So if we think about Black Friday, that's where that notion came from. So that is significant because it is a big shopping day for everyone across the board. And what that means is that many stores we're expecting a large crowd, but lo and behold, what has happened over the course of the past couple of years, of course, is COVID that sort of threw off those numbers quite a bit. But it seems, based upon some of the data that was coming out over the course of the weekend, then it was a little bit of a return to convention, a little bit of a return to normal, if you will. Many stores sort of have done away with those early morning, like 4 a.m., 5 a.m. blockbuster deals. And a lot of that is to basically keep people from fighting each other because the world is getting crazier and crazier out there. Another mass shooting at this one at a Walmart. And the reality is that they have decided to eliminate a lot of those doorbuster deals because the crowd would get there early, start to fight, have to stand in line, things like that. So they've sort of gone away from that. But after a couple of years of COVID, it looks like the crowds are actually starting to sort of kick up, if you will, an 18% increase in sales at physical stores from 2021. So that's certainly an increase in those sales. All in Black Friday, about $9 billion in spending. $9 billion. That's actually up from last year by about 1%. So the reality is that you may think, well, wait a minute, how are they spending more money? And I thought that the issue was that with inflation and things were getting tighter, and that's certainly the case. But remember the story that we've been talking about for quite some time, and that is that there's still a lot of excess savings in the economy, in the consumer's wallet. That comes about as a result of the government stimulus checks that were all sent out, but also the lockdowns, right, which prevented people from going out and spending money in much the same way that they would have. So it's still estimated that that excess savings, which at one point was well in excess of $2 trillion, almost $2.5 trillion, is still hovering around about 1.2 to 1.8 is sort of the range of where that excess savings still is. So despite inflation, you still have a lot of this excess spending or excess savings that is still hanging around. Retail sales in October, for example, were the highest in 8 months. So certainly a pretty significant amount of spending that's happening. But if you're sort of observing sort of these spending patterns, and the reason, of course, why consumer spending is as important as it is because that's a major driver of the economy, right? Somewhere north of 70% of the U.S. economy is made up of consumer spending, which is why it's always a pertinent topic for us on the program. The reality is that if you look at how much they've spent down or how much the average consumer has spent down that excess savings, the reality is that they've got certainly a healthy chunk left, but at the pace that they are going at, that excess savings above the normal amount that the consumer would typically have will be used up within the next 9 to 12 months. So pay attention to this excess savings. We've certainly talked about it on the program before. The reality is that is really helping boost spending, perhaps disproportionately. Again, the ripple effect of COVID. Here are the savings numbers. In 2019, just before COVID hit, households saved an average of about 8.8% of their disposable income. That jumped in 2020, the year of COVID, to 16.8%. Combined with stimulus checks, lockdowns, weren't able to go out and spend money at restaurants, travel, and the what. That savings rate in 2020, that 16.8% savings rate in 2020 was the highest annual savings rate on record, right? As you had these stimulus checks, as you had the inability to spend dollars, savings, of course, went up. In 2021, the savings rate moderated to still 11.8, still higher than pre-pandemic level at 8.8. However, during 2022, last year, it has fallen. And we're going to get you those numbers to help put some perspective on this consumer spending and how ultimately that impacts everything that we talk about economically. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. $9 billion was spent on Friday, Black Friday, obviously a very popular shopping day here in America and probably around the world to a certain extent. The reality is that it also saw, again, after a couple of years of COVID cautiousness, and I guess there's still some cautiousness out there, or at least it should be, it's still lurking out there. The reality is that it was about an 18% increase in traffic at physical stores over 2021. The backdrop of all of that, though, might leave you scratching your head a little bit because with inflation and the higher costs of goods and services and things like that, you might be thinking, well, wait a minute, I thought everybody was going to wind up spending a little bit less than expected because of that background. And I think what gets missed in that conversation is just how much excess savings Americans had coming out of the pandemic, or perhaps largely as a result of the pandemic. There was an excess amount of savings that was built up, anywhere from $2.5 trillion plus or minus, predominantly, as you might well imagine, from the stimulus checks that the government sent out, along with the fact that if you wanted to spend the money, you really couldn't because stuff was locked down, particularly if you think about places throughout the rest of the country, maybe not quite so here in Florida, but in the rest of the country, certainly those lockdowns were pretty draconian in terms of the impact. And then that meant that people had less places to spend money. And so that excess savings is still around and widely estimated to be about $1.5 trillion plus or minus. So over the course of the past several months, the consumers have been spending that down, right? It's $2.5 trillion. Now it's $1.5 trillion. Hence, October retail sales were the highest that they had been in 8 months, despite inflation and things like that. So that leads to an interesting conversation of, okay, well, what happens next? Because based upon the current level of excess savings, then there should be at some point, sometime in the next 9 to 12 months, where Americans will have used up all of that excess savings. Before the break, we were talking about some of the stats in terms of the savings rate and how much that has shifted over the course of the past few years. So we'll set that table, but we want to welcome in our audience first to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, also one of its most listened to, whether it's on the variety of radio stations that we are on here on Sunday morning or on the World Wide Web, where we're one of the top 25 financial planning podcasts. Make sure you subscribe to us on your favorite podcast channel of choice. Have any problems finding us, you can find us either by looking up Dollars and Cents with Joel Garris of Nelson Financial Planning. Any of those keywords will get you to our channel. But if you get stuck or lost in that which is the internet podcast channel world, go to our website, nelsonfinancialplanning.com. Upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar to you, and you will get automatically connected to our channel on that particular platform. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. So just to kind of recap those savings, right? Pre-pandemic, it was 8.8%. So 2019, the savings rate was at 8.8%. During the course of 2020, the primary year of the pandemic, that jumped all the way up to 16.8. Pretty dramatic. Hence the excess savings above and beyond the normal level of savings that Americans have. 2021, it dropped down to 11.8. So still higher than the 8.8, but not nearly as high as the 6.8. 2022, again, as lockdowns ease, as people started to travel, as there was not any additional government stimulus, the rate dropped below 4% for 7 straight months. So this year, it's wound up dropping all the way below 4%. And in September, it went all the way down to about 3%, 3.1, which is the lowest level since the 2008 financial crisis. So you can kind of get the idea, right? 8.8 sort of pre-pandemic level, normal level, jumps up to 16.8, then gradually falls down, 11.8 in 2021. 2022, hey, that excess spending that excess saving is starting to get used up because the savings rate is gone below 4% for 7 straight months in the year 2022. And then in September, actually went all the way down to 3%, 3.1%. They don't have the stats out yet for October. But that gives you an idea of what's happening in terms of the consumer, right? Because the consumer is still spending. When we look at this data from Black Friday and Christmas shopping, it looks like the data shows that people are still out there spending. A 1% increase over prior year is still an increase in spending, particularly when you're talking about $9 billion getting spent in a day. The other piece that we like to watch, of course, is that those savings was used to pay down credit card debt. And the reality is that trend has also reversed. Credit card balances actually increased 15% year over year in the third quarter that just ended here in 2022. That, in fact, is the largest increase in over 2 decades. So some interesting perspective, if you will, on what is continuing to happen out there. Still a lot of excess savings, ability for people to spend money, and that consequently continues to show up in some of the economic data, which, if we're shifting gears to the Federal Reserve, creates an issue for the Federal Reserve, right? They are getting frustrated on their interest rate increases. Certainly, they would like to see more of an economic slowdown as a result of these interest rate increases, but there's a variety of reasons why that hasn't happened. First of all, it hasn't been enough time to have these interest rate increases have an impact economically. That's number one. Number two, you're fighting this headwind of folks still have a lot of excess spending, which won't be used up for at least another 9 to 12 months. Combined with that, there is, of course, the labor market. And then that segues us into sort of our next conversation about the labor market and what some of the data tell us there. Because as we know, the Federal Reserve has been fighting this battle against inflation, right? They keep raising rates to try and curb inflation. Why is that going to slow the economy down? Well, it would make sense that it's going to slow the economy down because if you raise interest rates, what do? You raise the cost of borrowing. If you raise the cost of borrowing, well, that's kind of a fixed cost. Ultimately, as a business, you would have to then make other decisions. What's your other big cost in terms of a business? Well, it's labor, it's people. So then that typically is where you see businesses sort of try and reduce expenses is by eliminating some of their employees. And so the reality is that has been a transition that has happened much quicker, right? As the Federal Reserve has raised interest rates, it generally leads to higher unemployment, which then tampons down growth. And so because of that, then you've got more people sort of vying for the same job, which then also tampons down wage increases, right? As we've seen over the past couple of years, employers have been having trouble finding people, so that has contributed to a decent wage increase because as employers, you're competing for talent, you're competing for people, and so you've got to pay more in order to compete better, and that has led to some wage increases. So by creating a little bit more unemployment, then you can also help to tampen down wage increases, which is, of course, a big driver of inflation as well. But here's the thing. I think this is the thing that the Federal Reserve may be missing, if you will, and that is the labor market could have changed a little bit while we were not looking. And certainly when you start to look at some of the statistics on it, first and foremost, there's an aging population, right? Pre-2020, pre-COVID, there was a participation of about 63% workforce participation. Today, it's down to 60%. That's a pretty big gap when you start to think about it. And when we get back from the break, we're going to quantify exactly what that gap means and how it relates to ultimately how the Federal Reserve is going to move going forward in terms of interest rates. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. A changed labor market, and what is that going to do to the Federal Reserve and how it perceives what's going on that side of the equation? As we all know, the labor market, one of the things that the Federal Reserve looks at to determine how effective its interest rate increases are. One of those impacts of the interest rate increases, right, is if it increases costs of borrowing, it increases costs for employers. So employers then have to reduce expenses somewhere. Typically that comes in the form of a change in their labor rosters, right? Unemployment typically will go up, but what's happening is then right now, the labor market statistics are sort of changed a little bit. And we raise the concern, or we raise the issue of, is the Federal Reserve operating more in how things were than how things are, particularly when you look at labor participation numbers. Pre-pandemic, pre-2020, labor participation numbers were about 63%. 63% was the labor participation rate, the number of people that were working amongst the number of people that were age eligible to work. Today, that number is about 60%. So that 3% may not seem like a whole lot to you and me, but when you put it in real numbers, it's the equivalent of about 5 million people. Now, some of that's COVID, because folks not wanting to return to the workforce, still concerned over COVID, maybe immune compromise factors, concerns, things like that. Some of it's career change. You maybe just had enough and looking to change careers and perhaps retire early. Some of it, meanwhile, is a baby boom generation. Remember, it's where a lot of the working age people are, that is simply retiring. And maybe COVID helped to accelerate that, but that's significant because it's got the power to sort of skew the data, if you will, right? So Federal Reserve meeting in a couple of weeks, coming up on, I think it's December 14th, 2 weeks from now, plus or minus. And it's widely expected that they're going to raise rates by 0.5 percentage point. And that's after raising rates a total of 3.75 percentage points in the space of just 9 months. That's the fastest ever. And again, we share that concern, and I've certainly been talking about a little bit on the program over the past couple of months, that they may be getting too far forward on their skis, if you will. If you've tried to ski, whether it's downhill or whether it's water, you know that when you get too far forward on your skis, bad things happen. And so that's the problem. The more that the Federal Reserve kind of thinks about the labor data, what it existed before the pandemic. Our view certainly is that it's really time for the Fed to take a few months here and just kind of see what it looks like, because of the desired result of what they're looking for in the labor market piece of this equation. They might not ever really get there because you've got an aging population that is retiring. And for certainly many people, COVID might have accelerated that retirement. So this notion that you're going to have some continued pressure to try and get to that different labor number, it might not be the case. You really may have a situation where the demographics have created equilibrium, if you will, faster in the labor market than interest rate hikes could. And then if you continue to just raise interest rates because you're looking for a particular number in the labor market, then you could wind up increasing the chances of overshooting. So certainly some commentary on the labor market and what it looks like relative to the Fed. So welcome, of course, to the program. This is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's most widely listened to radio program, coming to you on a host of radio stations throughout the Central Florida region here on Sunday mornings. Also, one of the top 25 financial planning podcasts on the World Wide Web. We encourage you to subscribe to our many podcast channels, and in particular our YouTube channel as well, where you get to see the video of us doing this show in person. And on Sunday mornings here in the office, it's relatively quiet. We're coming to you from our studios inside of our office, our official Nelson Financial Planning Studios. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. Speaking of the holidays, we heard the headlines that they mentioned during the prior break, that bottom half of the hour break. Looks like it's a 6% increase in sales over prior year. I saw an interesting statistic, and I thought it was kind of neat to share it, particularly since this program, we're talking a lot about consumer spending, holidays, things like that. So, as you might well imagine, in the holiday season, there is a lot of interest in Marvel and Star Wars toys. Certainly when my boys were younger, there was a lot of money spent on those two franchises. The numbers, when you look at those numbers, are just huge. And the staying power is just dramatic. Here are the numbers, and these are the numbers actually from a Marvel perspective. So there's Marvel Cinematic Universe, right? The U.S. box office, latest movie is Wakanda Forever. It came out, I think it had a huge gross on opening weekend. It continues to do very well in the theaters. But if you think of that Marvel Cinematic Universe, right, which is the Black Panther, Iron Man, Guardians of the Galaxy, all of those, what you'll find is that since the release of Iron Man, which sort of kicked it all off in the year 2008, there's been 19 movies in the last 14 years. U.S. box office revenue, and this includes a couple of years in the pandemic too, $10.5 billion for the Marvel Cinematic Universe, which is movies that involve Marvel characters. That gross amount, for perspective, is twice as much of revenue as what the Star Wars franchise had. So I thought that was kind of an interesting statistic, particularly on this Sunday, because a lot of conversation about consumer spending and Christmas shopping, and certainly some interesting numbers that continue to drive the staying power and the amount of dollars that are involved when you think about those two main Star Wars and Marvel characters, how much they are driving part of the holiday shopping. And I'm sure if you've got anybody, under the age of 16 or maybe older, then you've probably got something in your shopping cart that involves either one of those two franchises. So certainly some interesting numbers that we thought would be neat to kind of share on the program, given the timing right after Black Friday. Also, we want to get into this. We talked about it at the top of the program, and I think this one may actually have to carry forward to next Sunday as well. But we're going to kind of set the stage and talk a little bit about the factors that come into play when you start to think about how much you can really spend in retirement. And I think all too often people rely on some general rules of thumb. I know certainly if we're having a phone conversation with folks or just kind of have a general review session, we'll certainly be the ones to use some general rules of thumb as well. But the factors that come into play when you're looking at how much income you can take safely in retirement really are much, much broader than what you would imagine, particularly if you're using one of those online calculators that really doesn't take into account a lot of these factors. So in the next segment, when we get back from the break, we're going to talk about some of those factors that come into play when it comes to determining how much retirement income you can receive in retirement. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So how much can you really spend in retirement? That's the big question. And it really truly depends on a tremendous amount of factors that you need to be thinking about. And one of those factors, or perhaps that false sense of security, comes from the fact that the assumptions that are behind the typical retirement income calculator that you would perhaps see online or maybe use a piece of software for, or whatever the case may be, they don't really work as well as they should. And I think that's predominantly because there's so many different factors that come into play. Most of those calculators assume that you're in good health, that you don't want to leave money to anybody once you pass, and that you'll claim Social Security as soon as you retire. Those assumptions that the basic retirement income calculator online makes only apply to about 4% of the population. So a pretty small minority of folks are going to be able to accurately rely on these online calculators. So in this segment of the program, we're going to talk about some of the factors that you need to be aware of to put into that thinking of how much money you can successfully spend in retirement. So welcome to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite podcast channel of choice. Just look for Nelson Financial Planning or Dollars and Cents with Joel Garris. Any combination of those words will get you to our channel. And then once there, just subscribe to us, and then that way you don't have to find us again. Have any issue locating our channel on any of those platforms, just go to our website, Nelson Financial Planning. There, upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar to you, and you will get automatically connected to our channel. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. Maybe one of those changes has to be understanding what some of the factors are that come into play when it comes to determining the proper amount of income that you can get in retirement. Those online calculators, as we said, really the assumptions in them only apply to like 4% of the population. Much greater customization is needed to develop a successful retirement income plan than just going online and working through a calculator. Each person's certainly unique and not just accumulating savings over time, but also accumulating differences. As we're accumulating our savings over time, we're also accumulating differences in how we're going to spend that money. Differences in health, differences in desires, differences in viewpoints, differences in bucket lists, things like that ultimately are unique to each individual and ultimately determine how much you can successfully generate for income out of your savings. So what are some of those factors that you really should take into account for better accuracy of determining how much money you can take in retirement? Well, first and foremost would be the obvious: health, right? What shape are you in? How long is that money going to need to last is highly correlated to your health, right? That should make sense. One review of more than 22 different studies on the matter said that a change in longevity at the point of retirement between someone who says that they are in poor health at retirement versus saying that they are in excellent health is about 5 more years of longevity. So even your perception of what your health is when you're at retirement, or the perception of what your health is at your current age, and you have to be kind of honest with that answer, the reality is that the difference between viewing yourself as in poor health versus in excellent health, it's about 5 additional years for that viewpoint that you are in excellent health. So put that into numbers, a 60-year-old in excellent health has about a 1/3 chance of living to their 90s. So that's a 30% chance, a 1 in 3 chance that they're going to make it to the 90s. That's an extra 30 years. So obviously you want to prepare accordingly. So that means that perhaps you adjust your withdrawals, particularly in tougher markets, right? When the markets are tougher, you don't want to be taking out as much as you were when the markets were doing well, because if you're doing that, then you're taking more shares out of your account to generate the same amount of income as you did when the markets were higher. So one of the things to be thinking about, particularly if longevity is in your blood, so to speak, then you certainly want to adjust how much you're taking, particularly during tougher years. Or the alternative is during those better years, the better strategy is to make sure that you are actively rebalancing, trimming profit, if you will, during the good years so that you can use some of that, or more so, use more of that during the course of those tougher years. So there's a couple of different strategies to really be thinking about, particularly if you look at how things play out from a health perspective, which obviously determines longevity. The two strategies there are obviously look at how much you're spending, try and reduce that in bad years. But the better strategy, in our view, is during those better years, during those good years, then to rebalance and to take some of that profit off of the top, so that when you're spending in retirement, you can go to that particular position and ultimately be able to utilize that rather than having to utilize something that is down in value. So obviously health becomes a big, big factor in that. Number two is sort of the timing, right? When are you going to retire? The typical ages that it kind of breaks down is 62, 65, 67, or 70. And all of those are related to Social Security and to a certain extent, Medicare. And so there are certainly pros and cons sort of at each age, right? At 62, great, I can start Social Security, but I can't get Medicare. The Social Security that I start at 62 is less, significantly so, than what I would get at my full retirement age at 67. 65, hey, that's when I can get eligibility for Medicare. Still going to be subject to a reduction in my Social Security, but not as much as if I had taken it at 62. 70, that's the age where you can get your maximum amount of your Social Security benefit. And the reality is that you've got expectations in terms of retirement versus what actually plays out. And this is where these ages start to kind of morph. According to a recent study, about 10% of those aged 62 to 64 expected to retire. Okay, so that age group expect to retire only about 10%. The reality is about 30% of them wound up retiring during that age group. So certainly some differences in terms of what we think is going to happen versus what actually happens. So we've got some more stats on that, along with a lot more factors. As we said, we will have to table a lot of this conversation to next week's program. So stay tuned for us for next week's program to kind of go through much more of this in more detail. So anyway, welcome. That's about it for this week's episode of Dollars and Cents with Joel Garris of Nelson Financial Planning. If you like what you heard and want to learn more about how our team of certified financial fiduciaries at Nelson Financial Planning can help you, simply go to our website, nelsonfinancialplanning.com, or call the office directly, 407-629-6477. Have a great rest of your day.